This is a time where I think the rules are going to be updated, they're going to be changed, and the world is going to change as a result. We have something like 22 plus on our Reg Flex agenda. We simply can't sit still and assume that what was developed 50 years ago, 80 years ago, still holds true today. The laws, the rules need to be updated and addressing the new technology. We want to facilitate entrepreneurs in coming forth with their ideas to build these business models. Let the free markets be free.
Hello, I'm Paul Atkins, Chairman of the Securities and Exchange Commission, speaking to you from our headquarters here in Washington, D.C. In today's episode, I'm pleased to share a thoughtful discussion with SEC's Director of our Division of Corporation Finance, Jim Moloney. Jim is a well-respected leader at the agency whose wealth of knowledge and depth of experience will make this conversation especially insightful. So let's get started. Jim, welcome to our session here. I look forward to chatting with you for a few minutes.
Thank you, Chairman. May I call you Paul?
Of course.
All right. Thank you. Well, first, I just want to say what a pleasure it is to be here. Not just here today talking to you, but in the division, in the SEC, in Washington, at such a monumental time. This is a time where I think the rules are going to be updated, they're going to be changed, and the world is going to change as a result. So I really appreciate you having the confidence in bringing me back after, my years here back in the 90s. I know you were here as well, and bringing someone back like myself has just been such a treat. I've been here 6 months now, and it's just been wonderful.
Good. So what exactly brought you back here? Because obviously, you just said it's not your first rodeo here at the SEC.
Well, I did 6 years in Corp Fin. One of my claims to fame at the time was, Regulation MA, which at the time was deregulatory.
MA for?
Mergers and acquisitions.
There you go.
Yes.
Okay.
And at the time I was a young pup, and I was the rule maker, the sort of scribe, writing the rules, updating them. This was the Williams Act, and it was what governs business combinations, mergers, tender offers, and proxy solicitations. And at the time, it was a great opportunity, and that is what launched my career. And then I went out to the West Coast. I worked in private practice, big law for 26 years. And I did that mostly to see what's really happening in the outside world, because anybody can write rules, but unless you've been on the outside and seen how they are used, applied in practice, you don't really have that full perspective. So over the last 26 years at a law firm on the West Coast, I got to see that. And then lo and behold, I think it was sometime middle last year, I got the phone call which said, "Would you like to throw your name in the hat?" And had to have some long conversations with the spouse, my wife, Erin, and the opportunity was one I just couldn't pass up. And so a couple of interviews later, I came in, onboarded late last year. It seemed like right at the beginning of the shutdown. And that was some difficult times, as you know, because we were here, but we really couldn't do very much without the full team. And here we are, now with the full team back, fully engaged, and we are operating on all cylinders. So what brought me back? I think it was the opportunity to be here, to work with you and the other bright, intelligent staff and commissioners. It's just such a wonderful time.
Yeah, well, I really appreciate your coming out and moving across the continent to do so. And so you're doing a great job. So I'm really counting on you. So let's talk a little bit about your work, and because we have our work cut out for us this year. We have a lot of things to do on our agenda. So why don't we talk a little bit about the role of the Division of Corporation Finance? What does it do here in the SEC? How big is it? And, what are your real tasks?
Yeah, for those who may not be familiar, I think most lawyers who practice before the SEC know, but for those who don't, the Division of Corporation Finance is one of 5 or 6 divisions, and we basically regulate. I'd like to think of it as compliance. There's a lot of rules on the books. Public companies file their 10Ks, their 10Q, quarterly reports, their proxy statements, their registration statements, when they want to go public, when they're doing a merger. And we review, Corp Fin, the Division of Corporation Finance staff, review those filings. And then we give comments. And then the folks on the outside will amend and refine their disclosures to a point where we either declare the registration statement effective or we clear the proxy statement. And then the world goes on and the transactions are presented to shareholders. That's just part of what we do. We also grant relief from rules in the form of no action letters, exemptive orders. We also do rulemaking. As I mentioned earlier, Reg MA was one of the ones I worked on back in the day. And now we have something like 22 plus on our RegFlex agenda. That's a very large agenda, and I'm very excited, and we're tackling it. The team that we have working on it is amazing. We have them lined up, pretty much ready to go. Obviously, most of these will be proposing releases so that the public has an opportunity to read them, review them, think about them, and come back with comment before we move on to potentially an adoption stage. So really, the Division of Corporation Finance is doing quite a bit.
So just to unpack some of that, what's RegFlex agenda you referred to is what?
It's a great question. So for those outside, not in the know, the commission periodically publishes a list of things that is on the commission's agenda. So their initiatives, they may be things like simplify disclosure. It may be to address crypto assets. It may be to deal with proxy solicitors and shareholder proposals. There's some are familiar with the rules that we administer that have been challenged in court, climate rules. So there's all sorts of rules that either need to be refined, updated, amended, or in some cases cut back simply because they're not working.
So this whole agenda is kept by the Office of Management and Budget.
Yes,
the Office of
yes.
Information
And that just
Regulatory
foreshadows
Affairs.
what's to come. It doesn't get into very much detail, and it's really when the curtain will lift when the proposing releases come out.
Right. So President Trump created some news not too long ago when he sent a message out and basically was asking about semiannual reporting versus quarterly reporting, which is the rule today for public companies to release their financial milestones and their financial performance. So where does that stand, and what are your plans for the division on that?
Well, first, I think it's good to start with, okay, what is semiannual reporting? Today, most public companies, domestic, will file 3 Qs and a K. And for those saying, what's a Q? A 10Q, that's a quarterly report. So you have a quarter that ends on March 31, June 30th, September 30th, December 31. So you get financial information, MD&A, and other disclosures on a quarterly basis.
MD&A is?
Management's discussion and analysis.
Okay, thank you.
Along with the audited financial statements and the notes of the financial statements and any updates on risk factors. That's the cadence that we have today. And if you talk to most public companies today, by the time they're done with their first 10Q, they take a week off and then they jump into preparing for the next 10Q. And then when they get to the third Q, then they're preparing for the 10K. So most public companies, domestic, are in this cadence where they're constantly in a state of gathering information and preparing for the next report. This can be very time consuming. It can be very distracting to management. There are a lot of companies that are perfectly fine with this. They may be multi-billion-dollar market cap companies. Unicorns are a dime a dozen these days. They can afford it. But as you have said, we want to make IPOs great again. And what that means is we want more diversity in the size, shape of the companies that we have for our investors. So I think the semi-annual reporting, which would shift it to 1Q and a K, so basically a 10Q for the first 2 quarters and then the 10K, would alter the cadence. So what does that mean? That would give the registrant, the company, more time to focus on the business and provide some breathing room in between the reporting schedule. I'd say it's safe to say when it comes out, it will be voluntary. This is not something that is going to be forced down public companies' throats. If you like the current cadence, 3 Qs and a K, it's perfectly fine. Large companies will probably stay that way. Newer companies coming to the market to do their IPO, they might like and prefer, and their investors may prefer, that management and the board spend its time building the business, getting the company off the ground. This is true, I think, in the life sciences space with companies that are coming forth with ideas on drugs or therapies that could help cure people of something. When they first go public, Do you want those engineers spending all their time reporting on, financial statements and MD&A, or do you want them trying to get to the FDA drug trial number 1, 2, or 3 for some milestone of success? Other industries that might benefit from it, companies that are very, I would call them staid in that their financials are very static. Banks, smaller regional banks, very staid. Companies that have a royalty stream where they license things out. It's very, very predictable. Is there anything exciting happening, that they need to do Qs every quarter? So 3 Qs and a K? Probably not. Now, some may say, well, we like the disclosure. We like getting 3 Qs and a K. That's okay. Investors can choose to invest in a company that is following the traditional route. Or if it's an industry and a company that you think needs the flexibility and the breathing room to focus on the business, and that's fine. Invest in a company that's doing semi-annual reporting. I think let the free markets be free. Let investors choose. It's not just the retail. It's the institutional investors. There will be analysts that will still follow these companies. And I would point out, just from my experience, companies like to give stock options and restricted stock awards. Insiders, officers, and directors like to trade securities. Companies periodically like to buy back stock or sell stock. All of those activities require there be some information in the marketplace. So those companies will likely, even if they opt into the semi-annual reporting scheme, will likely then put out periodic, I call them flash numbers or financial updates in an 8K. They will likely continue to do earnings calls and investor calls. So there won't be a dearth of information. It will just be a curtailing of some of the information that investors don't really need and where the company's management, the boards, would prefer to be working on the business as opposed to continually reporting on a long litany of prescribed disclosures in our rules.
Right. And the 8K that you referred to is a periodic report that is a special.
It's a current report. It's
report,
called a
right?
current report, and it can come out when there's something important, like an earnings call or an earnings release, or, for example, there's been a material contract signed. So these 8Ks, they fill in the gaps between the 10 Qs and the 10K.
Right. So so is this whole talk about semi-annual reporting, is that a revolutionary concept, or is that
No, this has been done in Europe. It's been proposed here over 10, 20 years. So it's not a new concept.
And we used to have it
And
here.
we used to have it in the very beginning. I think what's happened is over the years, over the decades, it's become a constant demand for more information, more information, more information. And having worked in the private sector for 26 years, I have found personally, and working with companies and clients, that, not everything is material. And there are things that are not absolutely necessary every second of the day. We get up every day, we get in a car, we live our lives. I think most investors, they're not constantly watching and reading every Q, every K. So there will be financial analysts, there will be flash reports, there will be these 8K current reports. Information will be out there. It will be digested by the market. And if, frankly, it doesn't work, if a company decides they didn't like it, there will be the opportunity to change back to. So it's not a permanent election. It's something that you would check the box on the cover of your report indicating that you're switching over. And after doing it for a full year, you could switch back.
And I imagine that we'll hear comments as we go out with this
Yes.
proposal.
I've been meeting, and you have been meeting, a lot of us have been meeting with folks from all stakeholders. And there's a lot of different views on this. I don't purport to say anything is unanimous, but when I do see some new ideas, new approaches, I think they're worthy of consideration. We simply can't sit still and assume that what was developed 50 years ago, 80 years ago, still holds true today. I think there are other methods and approaches to disclosure that can benefit the markets and benefit registrants and actually add value, improve stockholder value for certain countries. It's not a one size fits all.
Right. So let's maybe move to the overall status of disclosure for public companies. So we've been talking about now, both of us,
Mhm.
about doing a spring cleaning of our rule book. So there's the regulation SK
Mhm.
that basically is the
Mhm.
backbone for corporate disclosure. Maybe you want to talk a little bit about that and what might be some of the high points there that we're looking
Yeah.
at, and what our process will be.
Sure. Well, Regulation SK is just a body of rules which have line item requirements that apply to your registration statements, your proxy statements, your quarterly reports, your current reports. And it's almost like a list of ingredients that you would put, they're mandatory to address in a filing. And those, when I started 30, 40 years ago, they were pretty thin. By thin, I mean you could fit them in one book. Now, today, they fit in 5 books. These are like volumes. It's a 5-volume set, and everything that we had before has grown, and I'm sure if we were to go back before I got in the game, maybe 75, 80 years ago, it would fit in, 30 pages. So what has happened is every time there's a crisis or a concern about something, there's rulemaking. And it sometimes comes from the legislature, sometimes it comes from the SEC or a little of both. And we've constantly added and added and added. And it's like 30 coats of paint on a banister. And I think what we're looking at now at doing is putting everything on the table and saying, okay, this is interesting. We have a lot of line item requirements that many people have grown accustomed to, but do we need them? You yourself have said there's stuff in the attic, stuff in the basement, stuff in the garage that we all keep, we all retain because we think we need. But then we never go in the garage. We never look at it. We never read it. There's disclosures that no one is paying attention to. But yet companies across the board are faced with the arduous task of having to disclose the same things over and over and over again. I think executive compensation is a great example where when I started 30, 40 years ago, in a proxy statement, might have been 5 pages. There was 1 or 2 tables, summary compensation table, 2 or 3, 4 top named executive officers, the most highly paid executives, and you had some disclosure. And then there was a paragraph about the director's fees. It might surprise some today that this has grown to 15, 20, 30 pages with 20, 30 tables. And I think probably while well-intentioned at the time, has grown to the point where there's so much information, nobody's looking at it. And you're actually confused about how much the top insiders are getting paid. So if we could just get back to root it in materiality, to root it in what I think a reasonable investor would want to see. Because otherwise, if everything is material, nothing's material.
Well, so then, as far as companies trying to deal with all of these requirements, and that 5-volume set of disclosure requirements. So what I'm sure that companies have lots of questions that they want to pose. So how does the division deal with that?
Sure. So we mentioned the portal that you did a public statement on, and we are getting now lots of input. And what I've been suggesting in my meetings and what we've said at conferences is, don't send us very long-winded lawyer-drafted letters about, what 99% of the world agrees upon, because 99% of the world agrees on 1%. What we'd like to get is, what do companies think is most important? What do investors think is most important? And what do other stakeholders think is most important? And then we're going to lay this all down on a table. We have a nice group of folks that are very energetic, probably half our age, who are familiar with these rules. And we are going to systematically go through them, and with the comments that we've received to date, go through and propose what could be cut back, what could be curtailed. And we're going to do it in a sensible way, in a reasoned way. This is not throw the baby out with the bathwater. This is basically getting back to basics, because if you think about it, 50 years ago, 80 years ago, people were making investment decisions on probably 1/100th of the information. And back then it was very, very, very material information that came out. And now there's just a lot of white noise. And I have heard, and I think you've heard, some folks say, well, AI will take care of all this. You just keep giving information and AI will simplify it for us. And
If it's hallucinating?
if it's hallucinating, or I think the story that we heard today was, somebody could come up with 3 bullet points, run it through AI to get a 20-page memo, and then take AI to bring it back to 3 bullet points. And I thought that was very apropos because AI may be an interesting technology that is evolving. Simply giving more data, collecting data for the sake of collecting data and information doesn't necessarily help the investor. If you force the marketplace to focus on what's material, investors in the markets will be able to focus on what's material. Too much time is being spent on deciphering the wheat from the chaff, as you've said before. And sometimes that's where the hallucinations and the mistakes come in. You get garbage in, garbage out. And I think where we are today is forcing companies into disclosing everything out of fear that they will get sued because they didn't disclose something. So now you have companies disclosing everything just because, and then we hope that that covered the harbor front and investors are left on their own to figure out what is really material.
Right. Even disclosing things in multiple places in their documents very repetitively.
One of the first things I did when I came on and we were digging out of the shutdown and the backlog, I think my predecessor had instituted a rule that whatever the important thing was, it had to be said 3 times, once at the beginning, once in the middle, and once at the end. And we had staff here reviewing filings to make sure that they said the same thing 3 times. And my staff came to me and said, Jim, could we stop doing that? And I said, yes, you can stop doing that. We don't need to keep beating people over the head with say it 3 times.
Right.
Distill it down to the most important risk factors, for example. I know that's a topic near and dear to your heart. When I started, there was not a line item for risk factors. It was not in SK, but companies did it. The bespeaks caution doctrine to protect themselves. Then at some point, we adopted a line item to say disclose your risk factors. And then the litigators got involved, the plaintiffs and the defendants, and it evolved to the point where there are 20, 30, 40 pages of risk factors. Or more. And then someone, probably well-intentioned, said, that's too long. We should have it shorter. So if you go beyond 15 pages, then there should be an executive summary. So now we have an executive summary, and we have a 30 or 40-page set of risks factors, and then they are filtered throughout MD&A, management's discussion analysis, and then they show up all over the document. And there's disclosure of risks that, as I think you've said, if interest rates go down, dividends may be curtailed. Or if taxes go up, dividends may be curtailed. There are some risks that are inherent in anything in life. Do we need an encyclopedia describing all these risks when they're self-evident?
Right. So one thing that we've talked about with respect to your division is being more receptive to questions from issuers and other people. So how are you pushing that forward?
Yeah, that's a great question. Again, when I got in late last fall, folks outside in the bar and the market participants said, Jim, there haven't been any no action letters. There hasn't been any guidance. What's going on? Why are these people not helping us understand the law? And I came in and I asked around my staff, what's going on? And they were honest and they said, well, we were told not to do that. And I said, well, that's crazy. I mean, our job here is to help the markets understand what the rules are and how to comply with them. So some of the things we kind of struck up the jukebox that we started putting records on, and we now have exemptive orders, no action letters, something called CNDIs, Compliance and Disclosure Interpretations, which is a mouthful. We have revised that to be CFIs, Corporation Finance Interpretations, or just call them interps. What is an interp? In the division of corporation finance, people call, people email, they have questions. By the time we get the same question 10 times, we publish the answer to that question. It's obviously pressing on many folks' minds. So we're back in business. We're putting out guidance. We're in the game of transparency. We're telling folks what we are doing. We are taking meetings. I mean, I'll be honest, I take meetings with you and others here all day long. And when I get back to my desk, at 6 or 7, that's when I start going through my emails.
There you go.
There you
Okay,
go.
so
That's when the day begins.
That's the name of the game around here. So anyway, so I think we're at time. So thank you very much for sharing your thoughts here today. And so look forward to seeing what comes out from your division here in the coming months.
I'm very excited, and thank you for having me back.